Today's webcast, DNB's 2013 to 2017 Mid-Year Economic Outlook. My name is Lee Simmons. I am your moderator, and today's presentation is once again brought to you by our partner and presenter, Paul Ballew. Paul, of course, is DNB's Global Chief Data and Analytics Officer, responsible for the overall data and analytics strategy for the company. He's also a frequent guest on the likes of CNN, Bloomberg, and just this morning, CC. Our webinar today will examine the challenges and opportunities facing the European and global economic recovery, as well as a forecast of global economic growth through 2017. If a question for Paul, feel free to enter it into the Q&A at any time. And you can join in the conversation on Twitter at hashtag DNBIP. And now for today's webcast, Paul Ballew.
And thanks to everyone for joining us. As Lee just mentioned, we're looking forward to your questions and comments. We normally quite a few, so we'll try to get through as many as we can today. And for those of you that have questions we can't get to, we will follow up, and we look forward to that level of engagement. With regards to today's webinar, we want to cover a number of things. We want to start off by spending some time talking about this very unique economic recovery that we're experiencing, and unique economic events in total. We think it's important to provide some context, given the severity of the downturn, given the structural imbalances in the market economies as well as the markets. We all find it helpful to start there and give you a perspective on how the healing process is progressing. Second, our attention a little bit differently than some of our other economic webinars by focusing first on the emerging markets. This is a big part of the story for the second half of 2013 and probably for the years ahead. They have rock stars of the last few years in this very hesitant recovery. More recently, there have been a number of events that have raised questions about the sustainability and the direction of these markets. So we're going to go deep, give you our perspective, and then give you a few thoughts to think about in the next few years. As we can't ignore the ongoing challenges of macro political risk as well as full risk that are out there. We'll spend a lot talking about the Middle East. The key for us in looking at these risks is how they tie back to the economic stories in a number of regions. Then we'll go over to the developed markets, spend some time talking about the great hope of the U.S. This is all in relative terms because we're still talking about 2.5% to 3% growth rate. So we're not looking at the U.S. sprint ahead, but we believe that spending some time looking at how the U.S. is going through its healing process gives us insights with regards to other developed markets. We're going to wrap up by diving deep in terms of the European markets, talk about ongoing challenges of the Eurozone, give you latest outlook for how we expect the European markets to proceed over the next couple of years, and some ideas with regards to making your business effective in navigating through the waters that remain in this region, and to be honest, remain choppy in other parts of the globe as well. So let's dive in and talk a little bit about the economic environment we're in and set a little context. We'd like to remind everybody this recovery and the recession that preceded it is very unique. Most of us have not lived through this economic cycle or this type of economic cycle. It was due to a number of structural imbalances that have hit large parts of the globe. Those imbalances remain an impediment to the recovery process. And surprisingly, we're going through this choppy, uneven, hesitant period from an economic growth standpoint. It is to think about the fact that we're 4 years plus into the recovery, and we're all trying to feel the benefits. And the key part in making sense of where we're likely to head in the next couple of years. We downgraded our near-term forecast just a bit, again reflecting this uneven, hesitant, choppy growth and the headwinds that are still persistent in some areas. But on a positive note, we have upgraded our outlook in North America, but the healing process is gaining some acceleration led by what's going on in the private sector. And in addition, we've taken up our overall global outlook beyond 2013, in part North America, but also because there are other parts of the world where the structural imbalances have been put behind us, and other things stimulate growth in those markets that give us a little bit more optimism that the recovery will gain a bit of momentum. Once again, we assume the recovery globally will start showing 4% growth rates, but we're anticipating we'll shift from roughly about a 2% growth rate to roughly a 3% growth rate over the forecast horizon in order to feel recovery and ultimately an expansion, which will create some business opportunities, at least some parts of the world. Having said that, given the nature of the world we live in, we still want to remind everybody, and this is our safe harbor language, that there's a lot of headwinds that we still have to wrestle to the ground. For us, we're going to focus on two of these headwinds today. One is what's going on from a monetary policy standpoint in developed markets. We could say that's the biggest policy uncertainty out in the marketplace. Not fiscal policy, not austerity measures, but how the European Central Bank, how the Bank of England navigate an unprecedented amount of quantitative easing as they move to a less accounting stance and then ultimately an exit strategy. And then the third area for us in terms of headwinds to direct your attention to is what's going on in emerging markets. And as we look at emerging markets, we believe there will be an increasing divergence within emerging markets as it pertains to growth. We face headwinds in terms of emerging markets, but we have some that are really wrestling with their political and their social will to engage in the next round of structural reform that we believe is critically important to provide a jumpstart in terms of economic growth in the back half of this decade. A very unique economic cycle. If you get a sense of it, all you have to do is compare the recovery to prior recoveries, which are showing on the screen right now. We can look at this in terms of GDP growth. We can look at this in terms of growth. We can look at this in terms of consumer spending. The line is we had a severe economic downturn, and we had very hesitant, very subdued recovery. In terms, when I have this discussion, I like to challenge everybody to pause for a moment and think about the unique cycle, but also what's causing this cycle. And once we have a downturn of the severity we went through, this hesitant recovery, it's because there are substantial structural issues that take time to clear. And in many cases, they require behavioral or policy changes to help facilitate the healing process. And for the recovery, that's the inconsistent response in terms of behavioral changes and policy actions. Recovery, absolutely. It's also a recovery when we start to compare growth has been. So if we go back to the 7 years leading up to the downturn, 2000 to 2007, and we look at growth around the globe, in G7 markets, we were just below a 3% growth rate. You can see the strength in emerging markets, the emergence of areas such as South Sahara, a pretty period of growth overall for the globe. Compare that to the last few years and then extend it through 2014. In particular, those neutral imbalances manifested themselves and became visible to us were in developed markets. And the economic performance of the developed markets in the last 5 years has been less than extraordinary. Something that nobody really planned for, nobody anticipated, and as we look back upon this, it's a key lesson for us to always look at the fundamentals. Look at analysis, look at those bubbles, look at those areas that are unsustainable. The developed market, we have developed markets in general. We had this in housing, we had this in other sectors. We certainly had it in the run-up in consumer credit in a variety of markets around the globe. On the other last few years have been a much more positive story for emerging markets. In many cases, very close to the growth rates that we saw leading up into the recession. And in fact, a year ago, when you start reading the headlines and the conversation that was out there, it was very much an emerging market story as an offset to what was playing out in the developed markets. The story last year, the story this year, has been a change underway, and we thought it would be very beneficial today to start our discussion going beyond the developed markets and things such as this flat period we've seen, which is what we're showing with the Small Business Health Index, and going deep in terms of what's playing in emerging markets. Pause for a moment and think about the outlook and where the direction is likely to head. At the beginning, we do anticipate the global recovery will start to accelerate from this subdued percent growth rate to roughly 3% out in the end of the forecast horizon. We do anticipate the U.S., which I'll go into a little bit later, will see some additional acceleration in the next couple of years, which, by the way, will prompt the Fed to take some action. We assume that the Eurozone continues to crawl out of its double-dipped recession, and we do it right now that Japan's a bit volatile depending on what happens to structural reform. For the storyline, the change in our outlook is beyond us in the developed markets or other developed markets. It's the emerging market growth. And two things I draw your attention to. Number one, our forecast assumes that emerging markets in totality grow 5% growth rate, which is very subdued given the overall improvement in global economic growth. The second dynamic that's out there is the fact that a number of markets which had been outperforming in the early stages of the economic recovery have downshifted substantially, and we believe that those markets are going to struggle to crawl up to healthier growth rates consistent with what they do to generate positive real income growth. There are substantial question marks regarding Brazil. There are substantial question marks regarding India. There are substantial question marks in terms of Indonesia and Turkey. And so as we the outlook, that's one of the reasons we're calling this out as a key storyline in planning your business in the next few years. We think markets over the next decade will outperform developed markets. We still believe emerging markets are an essential part of any global business strategy and investment strategy. But we're putting a cautionary tone to this to be prepared for the fact that there are vulnerabilities that have emerged in these markets that have to be taken into account when one is planning one's global business, investment strategies, sales and marketing opportunities out of your traditional home market. So changes to the forecast horizon over the last few months. There are a number of things playing out. Aggressive monetary policy in Japan as well as structural reform. Part of the market story has been in China. On top of this volatility of emerging markets, which I'm going to go deeper on in a moment, has been a key storyline for us. Coupled with the commitment to structural reform, that's why question marks we just raised, we think are important to get into the forecast and the forecast horizon. There's a lot of work to be done with regards to regulation, labor market reforms, further emergence, and integration of global capital markets as global trade in many of the categories or many of the countries I just labeled. In the case we'll wrap up with today, last 6 months, I don't know if this is a change. It's an ongoing persistent pattern of uncertainty in Europe. We're our fingers crossed that the double dip is behind us, but we'll be realistic that the ongoing question marks of the Eurozone are likely to persist well in 2014 and maybe beyond. And it's one of the big questions of monetary policy tightening in the U.S. and in potentially the U.K. and Europe is what's the long-term impact on the Eurozone, and does that become the straw that breaks the camel's back in maintaining that monetary union. On the other hand, to wrap the section up on a positive note, we have continued to be very pleased with the deleveraging, the restructuring, and the productivity and the innovation that's driving the U.S. And just the public sector drag that's coming from austerity measures and sequestration, we're looking at the U.S. once again is inching its way up to 3% growth. And then we read all together with the ongoing questions of political risk, which I'll touch on today. I would encourage any of you on the webinar who want additional details on our assessment of political and sovereign risk, continue to work with our country insight team. We cover 132 markets in depth, provide detailed risk assessments in those markets, would be the insights from a planning standpoint. All right, talk about emerging markets is our first deep dive in terms of the conversation affecting our forecast outlook. As emerging markets, the first story is to really build upon the surge of the last few years, and in fact the surge predating the global downturn of 2008. It's been extraordinary and it's been pretty consistent across a number of markets. The fact growth, the consistent growth, the fact that while 2008 slowed that growth, it was a temporary slowdown and that these markets continued to show very strong growth. Markets were rapid movements in terms of equity prices, capital flows into the markets. However you describe it, these markets were a core part of the global investment strategy, and capital, especially as monetary policy became very loose in developed markets, we saw capital flows take off into these markets. About a year, maybe a little bit more than a year ago, we began to flash a little red, and in some cases just a little amber, but we put up the caution flags that developments play out in these emerging markets that were probably not sustainable, and in cases to drive growth we would have to see substantial policy changes. We're concerned about what would happen when the Fed and other developed markets central banks began to signal pulling back with regard to capital flows. While ultimately what has played out in the last year has been maybe not our fears, but certainly applying the caution we had a year ago. And you can in a number of measures, downshifting of growth being one of them. Fairly significant downshift across the board. The 6 emerging markets were highlighted in the webinar right now, these 6 emerging markets are the core of an emerging market strategy. They are the bricks plus adding in a couple of markets that become very, very important to overall strategies for many global companies. That is notable, but on top of that downshift, I would call out the fact that investment activities and the flow in these markets has come up rather dramatically as well. That too is management or sign of just the ongoing pressures and the underlying structural questions that are in many of these markets. If the Fed and other central banks continue to move to a position of at least less and then even be that to begin to modestly tighten, the question to ask is what happens when capital is not flowing into these markets as easily and abundantly? The final question beyond that is which of these markets can step forward and implement the needed reforms to deal with the short-term shocks that they're having to deal with, as well as the fact that they're not getting the headwinds we were getting with regards to some external factors such as the surge in commodity prices. These questions are extremely important in planning where emerging markets are heading in the next few years. And for us, bottom line is pay attention deep, understand the structural drivers in each one of these markets, look at things as their gross financing needs, also where they're at with regards to their primary balance. Deeper beyond that, to look at what those countries are moving forward with regards to implementing the needed structural reforms. For instance, recently as the signs of the Fed tapering were out there, the depreciation of currency and the ongoing challenges for the central bank are real symptoms of a much broader question with regard to the Indian economy. The ability to implement needed structural reforms to drive sustainable gains in productivity and innovation and true foreign investment in the Indian market to support 6-7% growth, that should be the norm for India. Much like India cannot rely on just hot capital flowing into the market to boost consumption or to boost public sector activities. It has to be on a more sustainable basis of growth and gains in productivity that generate real income gains. So at the beginning, the question mark for us is in emerging markets is A, how far do we temper our outlook, but then B, we spend more time looking at a divergent pattern of growth. I think our midterm forecast rather well. Our commitment to continue to go deeper on these markets to provide you the insight so you can plan your business accordingly. I would anticipate that this divergent pattern of growth is going to accelerate in the next few years, especially with the potential shifts that are playing out in the developed markets. A lot going on the emerging market side. The other big question out there, the outside boundaries of developed market, is what do we see next from a political risk standpoint? And this is part of our planning. As we look at year plus now of the Arab awakening in the spring that we went through, our estimate is that things have clearly played out the way we hoped they played out, but we've also become increasingly concerned that a number of other countries will be caught up in the wake of social, political, and unfortunately, potentially even military unrest in the region. So plan for the impact around the global environment outside of the core developed regions we all focus a lot of attention on. We have to take into account this risk. And for us, we've recently updated our outlook in a number of these markets. These were markets we had marks on to begin with. Right now, we would only label Tunisia as being green in our measures of progress with regard to driving levels of stability and political liberalization, which will support healthy growth going forward. Time for emerging markets, a challenging time for all of us with regards to the political, social, and military activities in the Middle East. If you put together, I would stress two things. Be prepared for lower growth than what we've seen. Be prepared for the divergent pattern of growth that will go along with it. What that means from a business planning standpoint is to keep your finger on the pulse as well as make sure that you're going deep in understanding the key drivers and the risk in these markets. Again, our commitment to you is to help you navigate these waters to the best of our ability. It is an interesting time, and it is one of the significant shifts in our outlook from where we were a year ago at this time as we're providing you an outlook for 2013 and beyond. Attention to a bit more of a positive story, and that's what's playing out in North America. The U.S. certainly is in a full court sprint at this point in time. We're not seeing growth of 3% U.S. in 2013, but there's weakness playing out in the U.S. and to some degree North America overall. And I think it's important for us as we're learning from this economic cycle to once again look at the healing process, get back to the structural drivers of any market. In the case of us, the combination of improvements in housing, the health of the corporate sector, the continuing capital investment, R&D, and innovation are all strengths that are underlying the U.S. recovery, and it's anticipate there will be a moderate acceleration in growth. As we look at the fundamentals in this market, the proprietary measures of D&B are flashing pretty. So if we look at delinquencies, if we're seeing indicators, which I'll show you in a moment from our Small Business Health Index, as the risk profile of business entities in the U.S. market, we've come a long way since the days of 2008. And I think it's very important for us not to underestimate the health of the private sector as a boost to U.S. competitiveness as well as underlying growth. On top, the U.S. is getting some boost or some tailwinds from a number of factors playing out, which is the energy boom in the U.S., which has taken the U.S. back up to being the third largest producer of crude oil around the world. You couple what's happening in natural gas, what's happening in terms of continuous investment in R&D and innovation, and productivity gains in the U.S. in the next few years are likely to be pretty strong. We're seeing this in manufacturing. We're seeing this in other sectors that are benefiting from the fracking technology and lower cost extraction and the renewed reserves that we're able to bring forward to the market. As we look at the U.S., one of the things we spend quite a bit of time on is the development of leading proprietary indicators on the U.S. and increasingly in other developed markets. So if you're unfamiliar with our Small Business Health Index, this is an index that we have built to gauge the health of that key component of the U.S. economy, and it's a forward-looking index. What we're very pleased with is the Small Business Health Index is proving to be a very strong leading indicator on the U.S. economy, both at the regional level, the vertical level, as well as the national level in combination. The Small Business Health Index is not telling us that we're likely to sprint ahead, but it is confirming for us that the U.S. is on a healthy trajectory of growth, whether it be corporate profitability, industrial production, or the healing in the labor markets showing up through payroll employment growth. Starting at October, we will be releasing our estimate of payroll employment in advance of what the Bureau of Labor Statistics does every month, and we are confident that we will be able to provide unique forward-looking insights with regard to the healing process and labor growth in the U.S. We're just that confident in our ability to build those insights because of the unique proprietary capabilities we have on tracking and keeping on the pulse of active businesses in the U.S. and especially businesses with less than 100 employees. The U.S. side, we're feeling cautiously optimistic, probably to describe it. We anticipate that the Fed will begin to shift, and this wild card out there in the marketplace we have to stay on top of. If you think about the Fed's journey, the Fed has three-part journey they have to go through. They signal to the market that they're going to taper off the stimulus that's been injected. Second they have to do is they actually have to start tapering and slowing down quantitative easing. So if you think about the Fed, their first challenge is they have to message it. The second challenge is they have to do it. And the challenge, once they move away from tapering the additional accommodation, is at the point they have to move to an exit strategy. It's a very journey for the Fed to navigate. So looking at the U.S. in the next years, we do not believe that fiscal policy is the most pressing risk for the U.S. recovery. We believe a disproportionate amount of the risk in the influences comes from monetary policy. We should stress that North America is Canada. We have rated the outlook for Canada. The fact that there's parts of the Canadian market that are showing some blight tendencies with regards to housing and the run-up in household debt. It's interesting to see how Canada has played out over the last few years. The Canadian economy, much like the Australian economy, weathered the 2008 downturn And no, it benefits reliance on natural resources and some commodities. It also benefits from the fact that it didn't have the same level of run-up with regards to asset prices and bubbles that we see in some other markets, such as the U.S. Canada, 4.5 years into the recovery, has some of those challenges impacting its outlook. We still think the Canadian economy will slog forward with positive growth, in part because of the strength of the U.S. The Canadian economy still has a high degree of dependency on the U.S., so that integration helps. But we anticipate there will be some domestic challenges in some sectors, and it's important to continue to gauge that. By the way, 2014, we will be rolling out the full suite of analytic capabilities on the Canadian marketplace that we have on the U.S. today, including the volatility rating, including the total loss predictor, because we feel it's critically important to provide those levels of diagnostics to help plan your business. So we're very excited about being able to mirror the U.S. economy from an analytic solution standpoint. That's North America. That's emerging markets. So now let's talk a little bit about Europe and spend a little bit more time in Europe than we do when we just do our overall global webinar. The journey in Europe is one that is pretty fascinating. And as I like to say, if I were back at the Fed and as a central banker, I would be having the time of my life, because this is quite an historical learning period for any of us. As we are up in the new, we're not assuming that we get major disruptions, such as the breakup of the Eurozone, but we believe that the marketplace will continue to struggle to gain substantial momentum. Therefore, looking at the outlook as being choppy, uneven, with some degree of uncertainty that has to be taken into account. Especially true as we look at the Southern European markets as well as France. We believe the markets continue to face a number of headwinds, like just short-term balance and short-term actions to keep the Eurozone together. In fact, a big part of the outlook of only showing 1/10 of a percentage point of growth in 2013 and sub 2% growth in the out years is the fact that we've got this conflicted environment of the European markets and France lagging, being off by the stronger outlook for the German and the British economies. Together, we still want to mention that there are going to be risks, and those risks are probably going to be with us not only 2017, they're probably with us for the better part of the decade, not beyond this decade. Of can the Eurozone stay together? What's going to happen with structural reform? What's going to happen in terms of some markets from a political standpoint are issues that have to be taken into account in planning your business. So about those risks is a key in our forecast. We do want to remind everybody in engaging the likelihood of the Eurozone and its ability to sustain beyond just 2013 or even 2014, there's elements that have to be taken into account. There's debt restructuring, there's stabilization capabilities, there's the health of the European banks, and then importantly, there's two other elements that are extremely difficult. One is integrated economic governance. So fiscal policy has to be consistent with a monetary union or consistent within a monetary union for a monetary union to sustain itself. The second that goes right along with that is the need for substantial structural reform in many economies to support similar growth, to support competitiveness. Otherwise, you get this high degree of dependency between some markets and other markets, which is just not politically sustainable over a period of time. Scorecard so far, I would describe it as a few years of passing grades. Right now, I'm not ready to send the student on to the next grade. There's a lot of remedial learning that has to occur, especially with regards to structural reform and full integration on the fiscal policy side. Also caution, unlike U.S. banks, the full recapitalization of European banks, and especially Eurozone banks, is not complete. And therefore, some tough medicine that has to be in with regards to rebuilding capital, as well as, in some cases, denationalizing or restructuring these financial institutions. This all together, it has been a tale of two Europes so far. We expect the tale gets a little bit more similar over the next few years, but we're still anticipating the Southern European markets, the Southern European economies lag their northern counterparts throughout the fast horizon. Why that case is that the structural shifts and the structural wins in those markets are severe. No matter how we look at this, sovereign debt or or in the case I'm showing you right now, Spanish property prices, is just a long journey to go through to deal with either bubble that have developed, run-up debt, sovereign debt, labor market competitiveness, the whole list of issues that have been front and center since 2009 are still largely front and center. There's some improvements. So in the case of Spanish residential prices, we are well off the peak, but we're still above where we were a couple of decades ago. And the housing market probably hasn't fully touched bottom, therefore, the Spanish economy. Likewise, Greece, there will be subsequent aid packages that are going to be required to help facilitate the rolling over of debt. So Italy, there's still big question marks with regards to political stability. Do we get an election? If so, does that election accelerate the journey that we're trying to go down? And a big journey is the ability to make substantial and deregulation, labor market competitiveness, and full integration into global markets and global access. So as you look at, from the World Economic Forum, the Intercompetitiveness Index, a gap point on global competitiveness is very essential. I always remind any customers is that when you look at countries like Italy or Greece on some dimensions of competitiveness like labor market mobility and flexibility, they are in the bottom third of 150 countries. That is just astounding to think that a developed economy has that degree of impediments with regards to needed labor market mobility. So the gene has to accelerate for us to feel better about these markets and their ability to achieve stronger rates of growth, catch northern counterparts, as well as perform at levels that we anticipate we will see in other developed markets in the next few years. So what of these structural reforms? I think gauge where Italy's heading, where Spain's heading, where Greece is heading, and Portugal, and to some degree France in the next few years, and beyond that, focus on what's going on in terms of key imbalances, look at those key drivers of competitiveness, and then understand the impact that monetary policy may have on either accelerating or disrupting the apple cart. We want to continue to call that out as an interesting thing that we're trying to sort through. If the ECB follows the Fed and begins to make a pivot, what to do with regards to the Eurozone stability and the underlying drivers of being required to refinance sovereign debt. It'll be an interesting question. So lots of questions in Europe, clear questions with regards to competitiveness and cost of doing business in these markets, and there's still question marks out there with regards to financial markets believe that the countries can continue to hold the zone together as well as make the needed reforms, and that, of course, goes hand in hand. So, for instance, that 10-year note, they still remain. If you compare where we're in the 10-year German note versus the 10-year Spanish note, that's still 200 basis points. These countries are monetary union together. Similarly, Italy, much larger economy, one of the G markets, third largest sovereign debt market. While it's not as disruptive as we saw from a positioning standpoint back in 2012 or late in 2011, that's still a very elevated level. If you look at zone in aggregate, it's still above the German levels also. And then, of course, if you look at Greece, we had to put it on a completely separate axis because it's still an 800 basis point premium versus comparable sovereign debt in Germany. It's not just us. It's investors hedging their expectations and the speaking that there remain question marks with regards to the journey that European markets are on as they go through this period of hopefully rapid structural reform and holding the Eurozone together as a monetary union. So lots of question marks out there. In Germany, we are more upbeat. We do anticipate that the German economy will continue to go through this period of recovery and accelerated growth. We'll keep our fingers crossed, talking about 2% growth by 2015. I just get there unless there's some major disruption within the Eurozone or some other exogenous impact. There are still questions out there with regards to structural issues in Germany, but the economy amongst all the large Eurozone economies, we believe, is best placed. And when you look at country risk ratings, we continue to have Germany in the upper echelon of developed markets around the globe, given its global competitiveness, given that Germany has implemented many of the needed changes that are required in other markets going forward. With the UK is certainly going through a bit of a rocky period and very aggressive austerity measures. At the outlook, we have been inching the outlook up for the UK. We believe the UK will be an overperformer with regards to European developed markets by the start getting out 18-24 months from now. There are positives out there, including housing. There's positives out there with regards to company optimism, which we think will drive investment and innovation. Again, there are question marks out there. Politically, there are some question marks. There's also a dependency on the Eurozone. While the UK is not part of the Eurozone, there's a trade dependency. So Eurozone underperforms expectations. We're going to continue to gauge and recalibrate the outlook for the economy and the recovery process. The other thing that I'll point out, like I do in the U.S., is the UK, from a central bank standpoint, has some question marks, one of which is to make sure that asset bubbles don't reemerge and that we don't out in front of the recovery with those imbalances building up. We believe that that's the number one question for the bank and for the Fed in the next year to 18 months as they evaluate the direction of monetary policy, not retail inflation, not even necessarily unemployment. They're not going to ignore those measures. They're not going to ignore the strength of the recovery or labor markets. We believe they're going to continue to have to pay greater and greater attention to asset prices and the heating up of things like housing or household indebtedness. And that's going to dictate monetary policy in the next year or so, which is one of the reasons we are spending the amount of time we're spending trying to gauge where that's heading. So together, with regards to the European outlook, unchoppy, hesitant, whatever you want to put on it, I think all of those descriptions are right. There remains certainty out there because of the Eurozone. We're not in the near term forecasting a breakup in the Eurozone, but we continue to focus attention on the underlying risk if we don't see rapid reform. For us, from a recommendation standpoint, it's about on the pulse. It's about understanding the downside risk as well as the upside potential, engaging in that level of scenario planning, and we are here to help you. We're here to help you navigate. We are here to help you understand what's laid out in a 50/50 midpoint forecast, as well as the other potential scenarios that could affect your business. I wish I could wave a magic wand and make this economic recovery behave like a normal economic recovery, but it's very ability that that's going to occur. What all of us have to do is to make sure we are committed to providing you the insights to navigate a very unusual environment that you have no reference point to gauge. Really interesting time for Europe. I'll include this part of our discussion today to say we're probably a little bit more optimistic than where we were, so I don't want it to be an entire dour conversation because we've had enough European dour conversations in the last couple of years. So a little bit of optimism. We just have to continue to provide a balanced view. Together, I want to wrap by reinforce commitment, as I just did to helping you navigate these waters. We believe in unique insight to help you gauge. We track 32 countries on a macro level, and I'm showing you our upgrades and downgrades of marketplaces or countries by region in the last year. The reason all this out is to just remind you of our commitment to understand what's going on a macro level, which and augments what we're doing at a micro level. The ability to track 137 million active businesses around the globe is core to what D&B does. But what we've done is we have linked to our unique macro perspective, and to navigate a complex operating environment, the combination of business insights coupled with market level insights, we believe, is essential to optimize your business performance. On top, we've also invested quite a bit of time in bringing forward a unique perspective on risk that are outside of the 50/50 forecast. So you gauge the likelihood of the event and the potential impact from a business performance standpoint. Now, certainly, as you see our list, you see the two I emphasized today as topics in the forecast we wanted to call out. One is monetary policy, not just in the U.S., but with the, as well as the Bank of England, and then of course the ongoing changes in emerging markets. Ignoring Europe, it's on our list as well in terms of the full disintegration of the Eurozone. We are committed to continuing to keep this in front of all of you to help you plan your business, and we have an ongoing process to stay on top of these risks, gauging ability to fully from a business standpoint, and therefore improving your ability to plan from a confidence standpoint. And as mentioned, our commitment from a country insight standpoint is comprehensive. The rankings, they go from extreme risk, and surprisingly you can see where the extreme sits in the world, to high risk, to the markets that we feel are much lower risk. I wish, by the way, we're more green. Not an economic statement. It is a macro-political and macroeconomic statement. Actually, the world now is not flashing a lot of greens, and that's a reflection of the unique economic cycle we're going through, as well as the structural changes that are out there. So if you have any additional questions or require information, please let us know, because these are core to our overall ability to provide you that informed perspective to navigate the very interesting and challenging environment we're all trying to plan our business around. So let's get full circle for you in terms of what we're doing and where we're going. We through an economic cycle that is very, very unique. It has a long haul because of the severe structural imbalances that are out there in the marketplace. More recently, emerging markets are going through their own version of this, and that is a complication to the environment. That the recovery will gain a bit of momentum, but we're going to continue to recommend a balanced approach to that because of the severity and the nature of the downturn, and because of new things that have developed on the horizon. We are keeping fingers crossed that it begins to feel like a recovery. I think in some parts of the world it will. However, continue to keep our pulse on what's going on out there because of the uncertainty in the operating environment. We're doing so from a micro standpoint, and we're doing so from a macro standpoint. The commitment to you is to help have the best informed perspective to optimize your business performance, whether to grow that business, whether to manage the risk that you're focused on managing on a day-to-day basis. So once again, thank you for joining us today. We will make sure you have these materials available to you so you can use them throughout your company and through your planning process. What I'd like now is turn it back over to Lee to respond to your questions and comments, and I look forward to helping you as we all continue to go down this journey, that when we look back 30 years from now, we will be telling our grandkids and our children about it, just like our parents and parents told us about the 1930s. I wish I was going to tell those stories, but I can assure you that 30 years from now with my grandkids, I will be telling these stories in droves. Thank you, and Lee, back to you.
Once again, for those in the audience, if you have a question for Paul, just enter it into the Q&A panel on your screen, and we will dive into the queue. Paul, there's been a fairly robust conversation around the ending of the quantitative easing program here in the U.S., and I noticed that its end, if it's not handled properly, that DNB considers to be perhaps the biggest potential risk to global business. Could you explain how an end to this program affects businesses in Europe, and particularly in the UK? And if so, should we in the UK be worried about this development?
It's a question, and I think it's one of the questions all of you try to work through as we're planning. When we look at quantitative easing, sometimes we think of it as a U.S. event or an ECB or a Bank of England event, or more recently, the Bank of Japan. We live in a world of global financial markets and interconnectedness, and for those actions by central banks have been impacting the global economy substantially, and this in a positive way, in some cases in a not so positive way. If the Fed goes through a tapering, which is what will happen at some point, and then perhaps a full exit strategy, it will impact businesses in the UK, it will impact businesses in general, and it will impact markets around the globe. One other instance, just to give you an example of where that impact is, if we go to an environment where interest rates start going up because of central banks and market expectations, what does that do to the ability to roll over sovereign debt in Eurozone countries who were struggling with rolling over sovereign debt just a year ago at this time. Be the straw that breaks the camel's back with regards to the euro. And if that were to occur, what are the corresponding ripple effects through the Eurozone with regards to financial volatility, run banks, other things that could impact? Now, I'm first hoping that scenario doesn't play out. I don't wish it on us, but that's the way we have to think about how the particular round of quantitative easing and unprecedented monetary policy potentially play out. In unexplored waters, we've never been here before. Because of the complexity of this, we are currently working on this issue very aggressively with marketing globally. And what we're doing for all of you who are of ours is we will be producing a white paper to give you our best thinking. It takes a little while to do so because it is very complex and the transmission mechanisms are hard to work through. So get some sense of what we're thinking about and how we're trying to get our arms around it. There are other effects. On the positive side, if quantitative easing comes to an end because the strength of the economy is justifying it, and the Fed, ECB, and the Bank of England navigated successfully, that's a really good thing. Do it with preventing asset bubbles from developing or pricking those asset bubbles before they get too large. So that's why there's some goodness in here, and there's potential not so goodness in here, and we're in a lot of time trying to sort through it.
A lot of industry observers are interested to see, how slowly the recovery has been developing since the late 2000s downturn, and there's a lot of debate that we will never return to the pre-growth levels that we achieved in the few decades prior to this recession. The boost from the tech innovation is petering out. Just wondering what your thoughts are on this, and what sorts of levels of growth would you expect to see in Europe in the next decade?
So the best days are behind us. I think that this particular cycle, just like the terrible decade and a half of the 1930s and 1940s, does bring forward some behavioral changes which will ultimately result in strong growth, whether that's activity or cost cutting or innovation or R&D. I think all of those are healthy buckets. And I do that for some markets and certainly businesses around the globe that the next decade will show an acceleration in growth. I think we'll be back up to trend growth levels at some point in time. And I think for those markets, we're going to see a healthy business environment. We believe that we will get more divergent patterns of growth within Europe because I think that more separation amongst developed markets. I also think we will get more separation amongst emerging markets. We had a period of time where the credit boom and the go-go times after 2001 resulted in a lot of bad playing out and unsustainable growth developing. I realize the last 5 years is resulting in healthy behavioral changes, whether it's debt levels coming down or companies getting back to innovating and investing to drive growth, improving productivity. All those things are necessary to put societies on sustainable levels of growth. The real income does not go up unless productivity goes up. Those are the immutable rules of economics that have been around for thousands of years. And we're looking at that. So I don't think our days are behind us. I do think we have to be prepared for even growth, and therefore it's essential to target where the opportunities are going forward. In the case of Europe, there are markets that we just have big question marks on. And come down to addressing the fundamentals. We're hoping on, but we feel
given the problems that we're seeing in the BRICS countries, which emerging markets do you expect to really shine in the next 5 to 10 years?
Another great question of diverging paths of growth. And 10 years with emerging markets lowered because there's a number of things that can play out. But we've become a bit more optimistic on markets like Mexico, where Mexico, there was a great recently about Mexico being the tortoise and Brazil being the hare, and that old parable. which I think is a good way to describe it. Mexico is undergoing some fairly dramatic transformation, maybe deregulating the energy sector. They're working through that now. They've already deregulated and started the journey on telco or the telecom industry, full integration into the North American Free Trade Agreement and all the benefits that brings to the Mexican economy. It's not like Mexico doesn't have issues that have to be dealt with, whether it's education or whether it's the drug or so on. But we look at those structural improvements as being strong predictors of sustainable growth and development. So a market like Mexico, we still feel very bullish on. We look at parts of Asia is still on the upside. We know, for instance, there's question marks about Vietnam right now. We still think that there are some fundamental positive drivers for Vietnam. We will become more optimistic again in India, I suspect, at some point in time if we see the next round of reform. So my advice with regards to gauge emerging markets is please work with us because we're dealing with that, and then please always come back down to the fundamentals. For the 3 decades I've done this, one lesson that I've learned more than anything else is that you can occasionally deviate from fundamentals and make it sustainable for a period of time, but I've yet to see many examples where a deviation from fundamentals is sustainable beyond the near term. And coming back down to those fundamentals is a painful journey to go down. Staying on top of the political issues, staying on top of the structural reforms, understanding the micro dynamics in those markets. It's one of the reasons why we're building analytic tools like viability ratings for emerging markets as well as developed markets. It provides you that level of precision.
Quite a bit of interest from our listeners in a little bit more about the insight in the UK. You spoke about the Eurozone crisis and the difficulties of keeping the single currency going. I'm wondering if you see a time when Britain will join the euro, or on the flip side, if the euro does disintegrate, what would that mean for business in Europe?
Forecasting within a 80% confidence range, the UK joining the euro anytime soon. I would never say never, but there's other places in Vegas I'd probably put bets on before the UK joins the euro. There's been resistance, socially, politically, but clearly the financial events of the years and financial market developments put that on hiatus. So we'll look at that occurring. We do believe that the UK will continue integration with Europe on other dimensions. It can sometimes be a rocky relationship, but the codependency, the relationships are extremely important going forward. With the Eurozone, such a journey to go down. Could monetary union for Northern European economies? Yes, we could. That's been one scenario we've looked at. Those are kind of a lot in common. We'll have to see. Time's going to play out. I think the near to 18 months is going to tell us a lot about the sustainability of the Eurozone. The shift from quantitative easing will be a significance for the Eurozone. Getting the German election will also provide some insight. We'll have the support for the next round of aid to Greece, because there is a next round for aid going into Greece. We'll have to see whether or not the reform energy in Asia picks up once again. And we've recently did the outlook for France, and we're downgrading the outlook once again for France. That's a country we have to put on our radar screen, which increasingly the competitiveness of the French and the German economy are not very compatible. They're getting out of sorts. And some questions. So as you can tell, Lee, we're spending a lot on this issue, trying to do the we can to navigate these uncertain waters because it's uncertain.
Paul, I think we have time for just one more question, and that brings us back to the U.S. and the oil boom here in the U.S. and in North America. It's been a huge advantage over European companies as energy costs are ramping up. I'm wondering if you can speak to how industrial companies in countries like Germany can cope with this kind of competition.
So certainly manufacturing or the industrial sector in general, you cope with by being innovative productive, add value. The partial down in manufacturing in the U.S. is not energy. Energy helps. There's also been a decade-long, 2-decade-long process of improving productivity and needing investment. If you go to an auto plant in the U.S., you do not find a parts bin anywhere in that auto plant. The key for any global sector and for any global business is the reason that innovation and improvitiveness is not a luxury, it's a necessity. And for those that are going to continue to succeed in a very dynamic global environment, those are must-dos with regard to business strategy. Of any option, for those of you that know my background, know I spent a decade at General Motors and I lived this front and center. And our challenge was our inability to fully invest to drive innovation and productivity and quality improvements in a place and comparable to the other automakers that were out there. That's really what was a core for GM. So my best to anybody in terms of a manufacturer in the UK, Germany, France, Italy is we live in a global economy. It'll be more of a global economy 5 years from now than it is today. Occasionally, policymakers try to slow it down. This has been done for hundreds, if not thousands of years. While policymakers will occasionally try to slow down, I do not believe that that march of history will time soon. Tech enables it, and that's the reality of having a successful business in a global economy.
And that just is about all the time we have. A quick note on today's presentation to our audience. This presentation will be available on dnb.com shortly after today's event, as well as emailed to all participants. And if you have any additional questions that we didn't get to today, please reach out to me, Lee Simmons at simmonsl@dnb.com. Paul, do you have any final thoughts you'd like to leave us with today?
Well, let's on two notes. First, thank you all for joining us once again. And secondly, if we can help you in ways you're planning your business, please do not hesitate to contact us. We appreciate your business. We appreciate your relationship with us. And our commitment is to help you succeed in this marketplace, irrespective of what the marketplace may throw at you. Thank you guys once again. And Lee, thank you always for hosting and for doing such a great job.
Thank you, Roger, and thank you again to everybody in the audience for joining today's event, as well as all of these great questions. Thanks to Paul Ballew and his insights on Europe and the global economic outlook. And with that, from all of us here at DNB, have a great rest of your day.